of risk. We've had a lot of questions on our blog about the nature of risk, and I had very few notes on this. This is a topic I really want to talk about off the top of my head. It's just so ingrained, it's such a natural thing to talk about. It's simply this: people think that in order to take money, you have to take more risks, and it's second nature. People know that investing in Enron stock to get a high return is riskier than investing in maybe Walgreens or Walmart. But that's not necessarily true on any given day. I mean, I invested in Walgreens stock, and the day after I invested, or 3 days after I invested, whatever the time was, maybe a week, they announced their first ever quarterly drop in profits. It was a minor adjustment, and the stock dropped by 25%. They've had 17 years of consistent quarter-by-quarter profit increase, but their costs have got out of control. There was some sort of change in generics, and the price dropped by 25%. Then, of course, the stock market crash came, and while Walgreens has been fighting to catch back up, I think they've largely made up that 25% drop, but it's been caught up in the overall crash. But the point is this, that risk in any particular strategy is dependent a lot on timing and perception. What I consider risky may not be something you consider risky, because you may understand that class of asset better than me. So, for example, I consider investing in stocks more risky than investing into a business or investing in real estate, because I have a lot of experience in investing in both in businesses and in real estate. And I think the risks of those sorts of things are very low. For example, in business, right, where you can get a 50% compound growth rate, does it imply a 10 times higher risk than, say, a CD? Probably it does, but the reality is if you start a business and it fails, you can then stop it very quickly and start another one. So there are ways to enter into businesses where you can limit the risk and probably increase the upside. But the purpose of this video post is not to tell you to invest in businesses, just to make a point that that what I call technical risk is in the eye of the beholder. But truly there is a scale of risks, and at the bottom end, as we all know, keeping the cash under your bed is probably the highest risk you can have, because somebody will probably rob you and take the cash. So the next lowest risk that you can have would be putting your money in a major bank in CDs, and just make sure it's under $100,000 deposit, so you're federally insured. So nothing short of the failure of the US government and their insurance company will stop you from losing your money. But equally, you pay a price for that low risk. You're only going to get 3 or 4% or 5% return on that money in the current market, and inflation is probably higher than the interest you'll get from the bank, or certainly not far behind. So you've got no risk of loss of capital, but you've also got very little likelihood of real growth in capital after inflation. So you pay a price for that. At the other end, if you're like a George Soros or one of the investors who goes into the stock market and invests in stocks and options and trades and all that sort of stuff, then we know we have a major risk to take there. That's what I call technical risk. But to my mind, technical risk is not as important as what I call absolute risk. And absolute risk is simply this. Absolute risk is the risk of not undertaking an investment strategy that will get you to your financial goals. If you have and your financial goals may be very simple, maybe to retire at the age of 65. So you may want to work from the age of 25 to 65. That's a nice 40 years, and you may want to retire on $2 or $3 million, which is certainly doable if you're working for 40 years. Or you may be 35 and want to retire at 55 or 60. Well, you may want to retire at 55. The reality is that, like everyone else who comes up with that strategy, you'll probably end up working to 65 or 75 because you'll fall short. But the point is that those strategies are very simple. If that's what you want, you just choose an asset class that gets you there. Your absolute risk of not making that is very low if you do basic things like saving 15% or more of your salary, sticking most of it in the 401k, getting your employer match, putting the rest into Roth IRAs or equivalent, and buying index funds and hanging on to them for that length of time. So the technical risks you need to take are very low because your absolute risk is low. You've laid yourself a low target, $1 or $2 million, a long time to get there, and there's plenty of low risk activities that you can undertake that will get you to that target. If you just do so, the highest risk you have is not doing anything at all. Take it right to the other end of the scale. Let's say you have this desire or need to become a multi-millionaire. And the multi-millionaire these days is, certainly probably $10 million. If you're aiming for something less than $10 million in more than 10 years, then you probably, by the time you get there, with inflation being what it is, you'll find you'll be struggling to live a millionaire's lifestyle. I can certainly attest to the amount of money that you need to live a millionaire's lifestyle today. So the point is, if you absolutely must have that millionaire's lifestyle in 10 years, because let's say you want to travel the world and you want to start, you want to start a movement and foundation that won't work on donations because you've got it might be a charitable foundation, it might be a honourable cause, but you simply have to drum up support to get there, and you want to do it very quickly. You need time and money behind you in order to kick that type of thing off. Also might be just to indulge yourself by going to live in Portofino and sailing a yacht around the Cinque Terres every day of the week. You still may need $5 or $10 million in order to do that if you want to live a high standard of living while you're doing it. If you just want to sit in the Sydney County district and drinking espressos, maybe you don't need $5 million, maybe $1 or $2 million will do. But the point is, you've got to decide what your end goal is and how steep the mountain that you need to climb is to get you there. How much money do you want? When do you want it? How much money do you have now? Plonk those three numbers into a compound annual return calculator. It will tell you what your compound annual growth rate is. So the absolute risk that you carry is simply this, that you won't meet that annual compound growth rate, and therefore you won't live the life that you desire. To me, that is what I call absolute risk. You work backwards from there and look at the tactics and the strategies and the investments that will get you there. And that's when you start to select from the range of investments according to the lowest risk investment that gets you to your financial goal. If you haven't got the stomach or the capability to invest in that path, then you better go ahead and revisit your goal. Because anything less, if you want to lower your technical risk, it won't get you to your goal. As simple as that.